Over the past 2 years, Robinhood stock has staged an aggressive recovery, surging from its 2023 lows to punch through the mid-70s. To hear the market tell it, this pricing reflects a completed metamorphosis. The consensus view is that Robinhood has graduated from a zero-interest rate meme stock casino into a diversified, de-risked financial super app. At $76 a share, Robinhood carries a $68 billion market cap. That's an enterprise value of 13.7 times trailing revenue and 31 times forward earnings. To justify this, a company requires perpetual mid-teens revenue growth and software-like margin expansion. But the empirical data paints a very different picture. Misclassifying a highly cyclical, transaction-dependent broker as a durable software-as-a-service compounder is a proven formula for capital destruction, and the market is making that exact error right at the peak of the cycle. Robinhood's recent profitability looks impressive on paper, but it is largely the result of a rare, overlapping set of external macroeconomic events, rather than permanent operational leverage. The first major tailwind has been peak short-term interest rates, which heavily padded the spreads Robinhood earns on its customer cash sweep programs. The second was a parabolic retail cryptocurrency cycle. Driven by spot ETF approvals, this created an artificial spike in speculative trading velocity. The final factor was the mechanical forced buying triggered by the company's inclusion into the S&P 500 index in September 2025. Those transient tailwinds are now aggressively reversing. In the first quarter of 2026, Robinhood's crypto transaction volume plummeted 47% year-over-year. Investors are paying a premium multiple for perfection at the exact moment the primary macroeconomic and retail speculative engines are stalling out. Look at this chart of Robinhood's net revenue. $4.61 billion. Slicing that column by durability, 58% is cyclical transaction revenue. Another 34% is net interest revenue. That leaves an incredibly thin slice. Hard recurring revenue constitutes less than 10%. A genuine wealth management compounder generates the vast majority of its income from sticky, predictable advisory and subscription fees. Robinhood's profile is the exact opposite. The underlying math invalidates the durable fintech thesis. With over 90% of its revenue derived from cyclical or rate-dependent sources, this business remains a high beta proxy for retail liquidity. That 34% bucket, net interest income, is heavily driven by Robinhood's $26 billion off-balance sheet cash sweep program. They earn a spread on idle customer cash, the most profitable capital in the company. But that profitability is structurally vulnerable to the Federal Reserve's confirmed pivot toward rate cuts. Robinhood's own financial disclosures provide the exact sensitivity metrics for this exposure in this matrix. A single 100 basis point reduction in the Fed funds rate instantly impairs their pre-tax income by nearly $300 million annually. The current equity valuation completely ignores this mechanical reality, capitalizing peak interest rates into the future. Those 49, a true fintech compounder migrating to an advisory model should exhibit steadily expanding average revenue per user. Instead, Robinhood's ARP actually contracted, dropping from $175 in Q4 2025 down to $155 in Q1 2026. This contraction proves revenue is tightly tethered to volatile trading rather than wealth management fees. A business model built on extracting high-velocity, high-risk trading fees from undercapitalized retail accounts lacks the structural moat necessary to sustain a premium software multiple. Even the reported profitability itself relies on an optical illusion. Robinhood printed roughly $2.5 billion in adjusted EBITDA for 2025, but this figure relies on adding back massive amounts of share-based compensation. Treating that $600 million in annual share issuance as a genuine cash expense reveals significantly lower true free cash flow. This level of aggressive equity dilution is protected by the company's underlying share structure. Robinhood relies on a dual-class system. Class B shares give the co-founders an overwhelming 60% voting block, locked in place through 2036. Because external capital is completely subordinate to founder directives, the stock warrants a permanent governance discount, regardless of how efficiently capital is allocated. To understand the sheer magnitude of the market's mispricing, we can use a reverse discounted cash flow model to extract exactly what growth rates the current stock price implies. Starting from a $63.4 billion enterprise value, this chart plots the trajectory needed over a 5-year horizon. It demands 18 to 23% compounded annual growth, forcing revenue to $13 billion, while demanding free cash flow margins settle into the mid-20s. This requires unbroken, compounder-like consistency from a business whose crypto revenue collapsed 47% year-over-year in a single quarter. Owning Robinhood at this price requires you to underwrite a permanent, uninterrupted options and cryptocurrency supercycle, completely ignoring the reality of the macro environment. Applying a sum-of-the-parts valuation to actual cash flows establishes 3 target lines: a bear case at 48, a base case at 72, and a bull case at 110. Trading near $76, the stock sits above base fair value. There's zero margin of safety. If retail volumes revert to historical means and the Fed aggressively compresses interest rates simultaneously, the fundamental floor for this equity drops into the mid-40s. Robinhood is a cyclical opportunity, currently masquerading as a durable compounder, and vastly mispriced at a narrative-driven peak. For investors with a capital preservation mandate, the recommendation is to avoid the stock, maintaining a 0% position size until hard recurring revenues actually de-risk the balance sheet.